Well, thank you, everyone, and thank you to our wonderful panelists. I have to say, I'm always an optimist, but I'm glad that we all agree there is optimism in the air. I also like the panel responses that our next conference is going to be in Miami, because we need definitely a warmer conference room. So all is good. So thank you so much. So we got some questions, and you can continue to submit the questions. I get them real time. So we got some really interesting ones. So we're talking about optimism. And there was some gloom and doom talk. So the first question, we're going to start with political risk. So I'm going to ask Julian to respond to this one. And then if any of the panelists would like to chime in, that's certainly welcome. So we talked about political risk. We talked about Venezuela was between Syria and Libya in our social turmoil index. So does that mean that we could look in Venezuela for a potential civil war?
Yes, of course. Venezuela is not really a tricky situation in terms of political risk, because all indicators point to a very high level of risk. Now, the key question regarding Venezuela is how do we exit from this situation? In the past, in this type of situation, the key question mark is related to the army. What will the army do? Will it continue to support the current ruler, or at one point will it decide to support the opposition? I think the key card is on the army side. As long as there is no intervention, there is no hope regarding a key change in Venezuela, unfortunately.
Great, thank you. Anyone else? Okay, we'll move on to the next one. Here's a question in regard to the current Trump administration. So Thomas, I'm going to ask you to first respond. Loosening a regulation, does it always yield a better and sustainable long-term result in your view?
Yeah, so the regulation is a wide topic. It depends what kind of, there's different type of regulation. You're talking about financial regulation or environmental regulation. So it's been clear that there's been a lot of deregulation in the front on the environment. Just looking at the EPA, how the EPA has changed. That's clearly, it clearly depends whether you think environment is important or not. So you could go faster with looser environmental rules, but in the long term it might be negative. Now also an important point is about financial regulation, and obviously we are not looking at a lot of deregulation on the financial front. We're not looking at a full repeal of Dodd-Frank like we have heard about in the past few years. So it's just going to be some changes for regional banks that could be good. But one should not forget that financial regulation could be cyclical. It's exactly the point that I remember there was a book in 2010, a critic on the Dodd-Frank rule, and what they were saying is that you tend to loosen financial regulation in good times and tightening it by times. And of course, if you have not enough regulation, it can create some financial instability in the system. And that's why also you look at the regulator right now. They are trying to take a deeper look in fintechs, for example, how to regulate fintechs, or how to regulate what we call the shadow banking, or all the lending activity that is taking place outside of the regular banking system. So no, yes, the answer is that you can make growth faster in the short run with taking long-term risk by deregulating too much. That's my view.
Stephen, from a Canadian view, is there anything that you would want to add on to that about regulation?
Well, on the regulatory side, I think in Canada we have taken different approaches over time. It's interesting on trade policy. We thought that most of the discussion and battle would be, or at least the interesting parts would be with the US. But in Canada now we've seen more internal debates. So Kinder Morgan and Keystone XL, other pipeline projects. So getting, in terms of the energy gaps that we have now between the prices that Canadian producers are receiving for oil. So deregulation has sort of been an area where we're trying to get to more energy to pipewater, to tidewater. And we're finding the sort of lack of certainty on the investment side being difficult in Canadian context.
Marley, would you like to add any additional thoughts from a world view, or?
I would just add that, of course, I think there's good regulation and there's not so good regulation. One of the key things that we work on at the World Bank Group and that globally there is great attention to is learning from past experiences about regulation and how regulation has helped in the past support growth and how it has potentially worked in the opposite direction. So I think global regulators are very much aware of how regulation can be a force for supporting economies and how regulation can work in the opposite direction. Also, regulations can have unintended impacts and unintended consequences. And oftentimes, regulators are more focused on advanced economies and the impact on advanced economies. And the impacts that regulation can have on emerging markets and developing economies may not be taken fully into the equation. May not be taken fully into the equation. And therefore, it's useful, especially as we look to have inclusive growth across the globe, to ensure that everyone has a seat at the table when global regulations are being debated and structured, so that at the minimum there's a clear understanding of what the consequences of these regulations can have on emerging markets and developing economies.
Okay, thank you. Next question, trade war. So this is, we'll ask Julian to respond, and then maybe Merle and the rest can add on to that. Trade war, will that bring benefits to the U.S. in the short term, with inferences on the re-election of the current administration? But in the medium term, what can we expect for the U.S.?
So, as it has already been said by myself and other speakers in different presentations, there are, of course, positives and negatives coming from protectionism. So, regarding the U.S., of course, in the very short term, if you decide some tariffs on some specific products, in the very short term, it helps some companies based in the U.S. As you know as well, on the other side, it also increases the prices of imported inputs. So in the end, the likely impact is an increase in inflation and a decrease in the purchasing power. So for example, at this stage in the US, some companies in some specific sectors are happy with what has been decided. Some other ones are less happy. You may have seen that some more and more people working for example, the agricultural sector in a lot of states in the US are more and more complaining because they have been targeted by retaliation measures coming from China, because they're complaining because the price of machines they use to produce is higher because the price of imported metal is getting higher. So in this type of situation, it means that I think we can expect some more decisions, unfortunately, in the coming months before the midterms. I mean, perhaps the US president could be inclined to decide now some protectionist measures regarding the agricultural sector, just to try to offset the negative impact for them. So that's exactly the type of vicious cycle we can fear, and unfortunately we're in the middle of it.
Want me to jump in? Okay,
Sure,
so
please, Stephen.
in terms of the trade war discussion, I think if the real battle between the U.S. and China, if that escalates, and you have, I think based on the slides that you showed, the systemic nature of the size of the shock there, that has the potential, I think, to take on the one hand the optimism that we've seen and slow things down. But on the other hand, I think I'd like to point out that what we've seen in terms of Trump's negotiating position, initially staking out this very far position in terms of what we saw in the autos, for example, where there was going to be a 50% American content rule. We're moving up from 62.5% to 85. That's come down to 72. So I think there's this initial push, and let's say even on the steel aluminum tariffs, where we started, and this was going to apply to $48 billion of U.S. imports. After the exemptions, it's $18 billion, and that those exemptions are temporary and they may come off. But the point I'm trying to make is that there is this initial negotiating position and then a bit of a walk back. So we're hoping that, at least on the China discussion with the U.S., that's the eventual outcome, is that kind of cooler heads prevail. Something else I would notice about, if you look at the competing tariff lists between China in terms of the tariffs that they would be imposing versus the U.S. and these $50 billion of intellectual property debates, there's a difference between China is imposing tariffs for large part on final goods. So that would be things like soybeans or airplanes and cars and those types of exported goods that the U.S. is selling to China. Conversely, on the U.S. side, and I think as was just mentioned here, it's largely imports, or sort of imported inputs and capital goods. 85% of the $50 billion would be on that. And so those are types of things where it will make U.S. consumers pay more money, and it will make U.S. companies less productive internationally. So there's a bit of an asymmetry there in terms of China has targeted congressional districts through certain means, but they've really worked more on final goods versus inputs. So in terms of the supply chain impacts, you could see an asymmetry in terms of what slows down in the U.S. versus what happens in China from that. But again, I think hopefully we will have a bit of banter and sort of discussion, and then eventually things get walked back a bit.
Okay, great. This is an interesting question I'm going to ask. This is, I think anyone can respond to this. How will climate change the discussion and regulation impact of developing economies of the world? Merle, would you maybe want to take a first attempt at that, and the others can add on to that?
Well, it's a huge topic, but
broad question.
Yes, it's a broad question. I would say that the shareholders of the World Bank Group, which are all the economies essentially of the world and all the countries of the world, are focused very heavily on climate change and the impact that it can have on economic development going forward. So just this year, for instance, Dr. Kim, who's the president of the World Bank Group, has promised that 28% of all commitments out of the World Bank Group, each of the arms of the World Bank Group, 28% in 2020 will go to climate finance. At the same time, he's announced that the World Bank Group will step back from some financing around fossil fuels in the primary development stage. So I think this is an area where there's an enormous amount of energy, and it's a field where, when we look at our projects at the World Bank, climate is one of the lenses that we are looking at in terms of the greenhouse gas emissions. Are they climate friendly? Do they fit our environmental and social standards and policies, which are increasingly are building over time to, I hope and I believe, create much more sound and sustainable projects. And these standards that we are helping to support at the World Bank Group are also being adopted by the private sector as well. So we find that many leading banks, global banks around the world, are adopting very similar standards. Sometimes, standards that the World Bank itself is catching up to. So I think there is a realization of the importance of climate and on sustainable development overall, both in advanced economies and developing economies, and that this is an area that is a growing field, a field where there's a lot of research and policy work that's going on, and will be an area where all of the multilateral development institutions, as well as other international financial institutions, will be taking up to ensure that their projects are environmentally and climate friendly, which in turn will help them be better projects financially.
I would definitely agree with that. At our banks, you can feel that there is a shift toward products that are more and more environmental friendly. It's definitely a direction that the financial industry is taking. And here, us at Natixis, here, we're thinking more and more to products that are more sustainable. Also, we are changing, of course, our habits. So I would completely agree with the comments you made.
On the Canadian side, I think people are seeing a lot of opportunities for clean tech and the exports therein, so carbon capture and those types of things. And then in more multilateral discussions for the environmental goods agreement from the WTO, I think countries around the world are working together to try to improve the trade and lower tariffs on these types of things, and that can only be beneficial.
Just in the recent news yesterday with California mandating the solar panels, is also part of that too.
But I think, in the US and in Europe, we talk about it as a long-term risk. But in a lot of developing economies, this is a top one risk right now, in the short term. There have been polls made in a lot of countries. Same questions asked in a lot of countries. And in a lot of developing countries, in Africa, in Latin America, and so on, so top one risk, this is not terrorism, this is not immigration, this is not economics, this is climate change. 2 weeks ago, I was in Senegal. The economy is doing very well. There is no problem, but a lot of hotels are now empty. They have been built, 10 years ago, just before there is no beach anymore. And this is right now, and the change is seeable within 10 years. So this is definitely a short-term risk in a lot of developing countries. Yeah.
Okay, here's another big, broad question, but one that is often in the news. What is the best way to shrink the Fed balance sheet? Or should it remain permanently large? Thomas, do you want to take the first attempt at that?
Yes. So we are talking about normalization of the balance sheet, of the Fed balance sheet, but we absolutely don't know what normal means. Not sure I will go much into the details, but the way the Fed conducts monetary policy has changed a lot. It's still using the Fed fund rate as the main policy communication instrument. So when you have an increase in the Fed fund rate, it means that the Fed is tightening financial conditions. But the way it's doing it is very different today. The way it was working in the past is that you had no excess reserves in the system. So what the Fed was doing is that it was playing with the scarcity of reserves to put pressure on interest rates. And now the way it does it is that since it has a lot of excess reserve, is that it also set an interest rate on excess reserve and also on overnight reverse repo for non-bank institution. So in my last slides, I was showing the pace at which the Fed is shrinking its balance sheet. And I think since the taper tantrum we had in 2013, the Fed is very, very careful in removing excess liquidity. So in 2013, Bernanke announced that they will taper asset purchases, and then there was a huge panic on the market. And now the way they are communicating very, very cautiously about the balance sheet. So I think the communication of the Fed on the balance sheet has been amazing. It's been very, very smooth. So they've been able to announce that they will shrink the balance sheet very, very gradually. They have a system in place that is a cap system and that will allow the balance sheet to shrink naturally. And I think that's the proper way to do it. They should not sell any asset. They should let it shrink kind of naturally. And then the next question, which is more a medium-term question, is what do you want for how you want to conduct monetary policy? Do you want to go back to a system in which you have no excess reserve, or do you want to remain in a system in which you still keep a certain amount of excess reserves? And I think the answer right now is that the Fed will keep a large amount of excess reserves on their balance sheet to keep conducting monetary policies the way they are doing it now.
I think that's true in terms of the ECB, the European Central Bank as well. I think we're in a bit of uncharted territory in terms of large accumulations of assets. But the one thing that we do know, moving from just the interest rate channel now to more the QE channel, is that there is going to be much more hand-holding to markets and much more clarity in terms of asset purchases are going to be X billion dollars a month, and then that will be slowing down. So I think markets reacted strongly in 2013, and I think policymakers got the message, and they're going to be a bit more careful in terms of the exit strategy.
And the thing is that we don't know what the effect of the normalization will be. We're still struggling to know what the effects of the QE, of the quantitative easing, were on the economy. So that's why they are walking on eggs here.
Okay, great. Well, I want to be respectful of everyone's time. So one kind of rapid fire question, I'm going to ask each of you to respond. So what would be, after we had the whole afternoon together going over all this wonderful data and the optimism, what would be your one key takeaway from this event that you want to share with our audience so they can in turn share with their clients and policyholders? Stephen, would you like to start with just one simple
Let me start with that.
takeaway?
Okay, I would say underlying outlook for the global economy is positive and is good. And I think that provided we can keep trade policy uncertainty in check, that we should expect to see a continuation from where we're at in 2018.
Marley, you want to go next?
I would say, and this is one thing I wanted to share, obviously it's a very difficult and challenging time for multilateral solutions and global solutions to global problems. So I would just want to share with you that during this difficult period, nonetheless, the World Bank Group has just gotten the go-ahead from its shareholders, essentially strong support from all of its shareholders, including its largest shareholder, the US, for a capital increase. So this is the largest capital increase in the World Bank Group's history. I think this is a very optimistic, upbeat way to something to share with clients if they're feeling a bit down on global prospects or multilateral prospects. And it's the first time that this type of increase has come when there really isn't a crisis in the global economy. So I think there are some reasons for optimism despite some of the clouds out there.
Okay, so I will take a more cautious, just to balance with the optimism. But no, it's the prospects, the economic prospects are good, but one should not forget that we are at a time where probably financial imbalances are building, so we should be careful. And also we need to, I'm speaking for the US here, you have a massive fiscal stimulus right now, which is completely unusual at the end of the cycle, which means that if you have a crisis in the next few years, you have less room for maneuver in terms of policy response. So just a more cautious note on my side.
And so I will be more positive on the other side, because, when we were here 3 to 4 years ago, we were still talking about, how do we exit recession and so on in almost all regions. Now the outlook is pretty different. So it's quite definitely much more exciting for businesses because they have plenty of reasons to invest in a lot of places. Having said this, the key word I think is, I would say, selectivity, because even though the outlook is definitely much more positive, as you have heard, there are still plenty of unknown oil prices, business confidence, what's going on at political level, and so on. So it means that even more than before, we have to look at the situation on a country-by-country basis, on a sector-by-sector basis, to see opportunities.
Wonderful. So we will wrap this up. A few housekeeping things. Coface produces a country risk booklet. You can go to the country risk where you registered for this conference to download that information. And there were also some questions that I saw around having the materials for today. So all of that is available on our website. And I want to thank, first of all, our Coface events team for pulling this all together. This has been months in the making, and I just think they did a terrific job. So if you can help me give them a round of applause. I also want to thank the venue. They've been a great supporter the last couple years, our sponsors, but most of all, our wonderful panel of esteemed colleagues really sharing their insights. And hopefully this was a great use of your afternoon. And thank you so much for coming and spending the time with us. Cocktails are served and ready to go. It's where you registered is to the left in the back foyer. So we'll see you there. Thank you so much for coming.